Chelsea Football Club has spent over €460 million in the summer 23 transfer window, taking their overall spend in 3 transfer windows since the takeover from Clearlake Capital and Todd Bowley to over €1 billion, or even over £1 billion. So how can Chelsea continue to afford to spend in the face of complex financial regulations and with a drain on cash? Other huge clubs across Europe and even in the Premier League are struggling to survive, struggling to make ends meet from a cash perspective and to comply with the rules. Check out our previous video on Everton and their current financial issues, and we've also reported other issues when it comes to Barcelona and Manchester United. So make sure you check those videos out on the channel when you get a chance. This channel, Football Finance Professionals, is brought to you by me, Neil Wood, a football finance professional and former senior finance professional at City Football Group, the parent company of Manchester City. This channel is dedicated to teaching you about finance concepts through the medium of football. So if you purely want to learn about finance using football as a vehicle to do so, or if you have an interest in football finance in particular, make sure you subscribe, hit the like button, share this video with your friends, and leave a comment down below. In our next video, we plan to take out a crystal ball and look at what is about to be reported by Chelsea in the 22-23 financial statements, which won't hit the press until next year. We are looking to see whether they'll continue to comply with the FFP landscape, which is just one aspect of whether they can afford to continue to spend. In this video in particular, we're going to look at 4 definitions of being able to afford that particular level of spend. Number 1 is cash. And cash is king in many people's eyes. In the world of football, a lot of clubs appear to be cash rich. And cash is a very liquid asset, and it's liquidity management that's key. We've said it before on the channel. Cash is actually worthless. It's what you do with that cash, how you make commitments for the cash that you've got, and how you fund the deficits where you have them that's key. A good treasury management function within a finance function, or even a separate team that is working alongside a finance function within a club, is critical. Now, not a lot of clubs are afforded the luxury of having a specific team, so it often falls on a limited number of finance professionals within the finance team to make sure that liquidity is managed appropriately. But having the cash, as you can appreciate from a personal perspective, is one way that you can afford to buy the things that you want to buy. And in the case of Chelsea Football Club, particularly under this new management, they appear to want to buy as many footballers as possible that look to hopefully align with their strategy on the pitch. Number 2, and which way round you take these, whether this is number 1 or number 2 in terms of priorities, is financial fair play or compliance, or the regulatory landscape in which Chelsea sits. The definition of being able to afford players or to continue to invest in players would sit in a wrapper of whether they comply with financial fair play regulations. From a UEFA perspective, there's a historical view called financial fair play, and now that's rebranded as financial sustainability regulations. From the Premier League's perspective, the terminology that we use is profitability and sustainability. A slightly different set of rules with a lot of similarities, but with some significant differences in some aspects that make it quite difficult to interpret both the UEFA rules and the Premier League rules side by side. We've got experience of this, and if you want to learn more about that particular topic, aiming towards understanding all about financial fair play, financial sustainability, or even profitability and sustainability, why not go to our website, www.footballfinancepro.com, sign up to our mailing list, and look at the course that we've designed alongside Loughborough University, the Professional Certificate in Football Finance. That course is designed to take you through step by step from having no knowledge about football finance all the way through to the complex landscape of financial fair play, whether that's financial sustainability regulations, the old financial fair play, and getting an understanding of how we've transitioned from one to the other, or even the Premier League profitability and sustainability rules. We also look at things such as how clubs are financed, the tax landscape, which is very rarely covered in courses such as these, and many other aspects of football finance, such as player accounting, management accounts, governance landscape, and even down to the basics of debits and credits alongside interpreting the financial statements. So check out the link in the description below, and if you're interested, why not sign up to our mailing list for more information. The third aspect of affordability is linked to the accounting principles that sit around the club. And primarily when it comes to player trading, this can be linked back to the cash profile of those player acquisitions and even player sales. If the cash is not collected up front, which is often the case in football, it's very common that amounts are deferred, or the consideration is deferred on the anniversary of the registration, maybe 1, 2, or even 3 years into the future. That has a consequence when it comes to accounting, and it does impact the amortization profile of the intangible asset that's being amortized, because it has an impact on reducing the intangible asset value, because the difference between the total cash that's being paid and the discounted present value, when you take into account that deferred consideration, is recognized as interest cost over the life of what is treated as a financing transaction, effectively a loan. Nothing in the world of accounting is free. So when you are negotiating a transfer deal, you need to understand the cash profile, because if it isn't collected on day one, it will have an accounting impact and therefore have a knock-on impact to financial fair play calculations, and could be the difference between compliance and non-compliance. But that's quite complex, so you don't need to worry about that too much just at the moment. But if you do work in football and you are responsible for player negotiations, please work with your finance function. In an environment where interest costs are so high, the cost of equity will be even higher, and the discounted present value of those transactions could be the difference between compliance and non-compliance. So the three aspects of affordability being the cash profile, that's outside of the player transactions as well as the ones that are related to player transactions, because debts need to be serviced, suppliers need to be paid, cash needs to be collected from customers, be it broadcasting deals, commercial deals, or even match day revenue, as well as those player transactions. The whole cash profile needs to be assessed, because if one day the players can't be paid or HMRC can't be paid, then that's going to be a huge reputational issue for any club. And clubs are always seen to have deep pockets. But the reality is that football clubs with rich owners do not have stacks of cash in the bank. The cash is being utilised, it's being invested, whether that's in the club or in the parent company or the investor's other assets. A lot of clubs are backed by very wealthy owners, and they do not become wealthy by leaving cash sitting in the bank. And that's the same for football clubs. So you can assume that football clubs will go by day, forecasting cash flows on a week by week, month by month, and even year by year basis. And the more you stretch out the forecast, the harder it is to forecast the cash flows. But it could be from one day to the next that the club is strapped for cash. An invoice that was due might not be paid. That might mean that a club may need to manage creditors, just the same as any other business. If a customer lets you down, doesn't pay on time, that could leave a hole in your cash flow that needs to be filled through liquidity management. And that's where we get back to the point around managing your finances, whether that's in the short term, medium term, or even long term. The fourth aspect of affordability, particularly when it comes to Chelsea, is off-balance sheet commitments. And this is the same across all football clubs. Off-balance sheet commitments are those items that are not recognised in advance or upfront when the player is registered. Only those amounts that have been committed on the day of registration will be recognised as intangible assets and payables, or even reducing the cash amount that's paid upfront. When it comes to contingent fees, things for player-related bonuses or performance-related bonuses that are payable as part of the transfer fee but not upfront, but triggered on certain events, they're not recognised on the balance sheet. And quite frankly, it's very difficult for even the likes of me to be able to estimate what those figures are going to be. They're hidden and detailed within each player contract. It's likely that there'll be some personal commitments that are performance-related that will go to the player, and some that will go to the player's former team, the one that they've been acquired from. So let's take a quick look at what Chelsea have spent so far and why they're in the position that they're in financially. Well, if we think back to summer 2023, that wasn't too far away. A total, according to Transfermarkt, of €462 million was spent in summer 23. That compares to the winter transfer window, which was a record €318 million, and the summer transfer window back in 2022, which was €279 million. Now, from our perspective, and you may want to check out one of our other previous videos on Chelsea, It looked as though the winter investment was a gamble to try to make sure that the team got back into the Champions League in 22-23, well, qualifying in that year so that they could compete in the year that we're in now. And that gamble didn't pay off, with Chelsea finishing 12th in the Premier League. That means that revenue will have suffered because of the finishing position within the Premier League in the year, but also the revenues for the 23-24 season will suffer due to a lack of Champions League qualification status. So the poor on-pitch performance that Chelsea had in the 22-23 season led to a lack of Champions League qualification, which would allow the team to focus on the Premier League in 23-24. Another summer of investment, taking that total spend to over £1 billion, means that you'd expect that Chelsea would be hitting the ground running at the start of the 23-24 season. And that unfortunately hasn't been the case for Chelsea fans. A very poor start to the season has had people talking about potential relegation threats. Now, realistically, it's unlikely that that will happen. But a realistic outcome for 23-24, if on-pitch performance doesn't pick up significantly, is another season of Champions League qualification that will go amiss. If Chelsea do not go into the 24-25 season in the Champions League places, it will put significant strains on the cash resources and the accounting and the financial fair play position of Chelsea Football Club. But for those of you with a keen eye, you will notice that Chelsea have adopted a sell to buy or even a sell to comply strategy when it comes to player trading. And that strategy is the only one that can really get you out of jail free from a compliance perspective. If this was any other industry without FFP, one, you could observe that shareholders would not continue to fund the activities of a loss-making entity. Eventually, the shareholder would say enough's enough, I'm not making a return, so I'm going to fold the club. But football is different. It's immune to that. It's seen often as a trophy asset from a football club perspective, and wealthy owners will be happy to fund what is deemed to be potentially a small amount in comparison to other assets and other ventures. So it's really the financial fair play or financial sustainability or profitability and sustainability regulations from Chelsea's perspective that they need to be concerned about. Backed by private equity investors with the ability to raise funds either through debt or through equity, and we've seen again recently that Chelsea look like they're about to go through another round of funding, that shouldn't be a problem. Liquidity management and the facilities to be able to manage short, medium and long-term cash requirements are likely to be there for the foreseeable future. So Chelsea fans, you don't need to be worried about that just yet. But what about the FFP landscape? The Chelsea's current ownership have self-reported the issues that have occurred under Roman Abramovich and the lack of disclosed information to UEFA. That has resulted in a €10 million fine from UEFA, which won't be accounted for as part of future FFP calculations because it'd be effectively a double penalty. But the Premier League are rumoured to be investigating that period of time, and in that period of time, Chelsea actually went on to win the Champions League. So Chelsea's competitors might have something to say about non-compliance in a period where Chelsea were very successful in the UEFA competitions, but that time has now passed. So it's very difficult to do anything about that from a sporting perspective. And UEFA's mood when it comes to punishing its members with regards to FFP compliance is one that's not as severe as it's been in the past. COVID-19 has led to a number of issues across Europe, and banning clubs across Europe for non-compliance in a period of time where COVID has decimated finances is not the right answer from UEFA's perspective. UEFA has tended to take a more relaxed approach to non-compliance, making sure that clubs comply in the future and potentially hitting them with a fine, as Chelsea have been hit with. And some may say it would be unfair to punish the current owners for something that happened under previous ownership. But compliance with UEFA's financial sustainability regulations or previous FFP calculations is not an issue for Chelsea at the moment due to their lack of participation within UEFA competitions, be it the Champions League or Europa League for 23-24. Even if Chelsea was in a UEFA competition, it wouldn't need to comply with the financial sustainability rules. Now, why would that be? Well, as we've said, UEFA have actually taken a relatively relaxed approach to FFP. And throughout COVID, they took the opportunity to rewrite their rules from FFP to FSR, or financial fair play to financial sustainability regulations. And during that period, they cut off the accounting results at the end of the 2022 season and restarted them again at the start of 22-23. That's the first period that will be assessed under the UEFA Financial Sustainability Regulations, but that period alone, that 1 year, will not be assessed. It will purely just be reported to UEFA and will be building up a new monitoring period, which will be 2 years in the next financial period, which is 23-24, and then 3 years in 24-25. So clubs that have had historical issues with UEFA, such as Manchester United, and you can have a look at our video on Manchester United if you wish, those issues have actually gone away now, because financial fair play from a UEFA perspective doesn't exist anymore for prior to 2022. So that's good news for Chelsea, and it's good news for all of the clubs across Europe. Not having to worry about the financial fair play headache over a period of time where COVID decimated the finances of football across Europe and even the world. So it's a sensible approach, we think, from UEFA. However, the Premier League is a different story, a different jurisdiction and a different set of rules. Although the underlying principles are the same, the basis of preparation is different. The principles on which the finances are prepared are different. And crucially, in this period of time where COVID has hit, the COVID impacted seasons still exist for Chelsea and all the other Premier League clubs who have to comply with profitability and sustainability, which is the Premier League's version of FFP. Now, although that may seem harsh in comparison to the approach taken by UEFA, the Premier League have taken a more relaxed approach to costs that are relievable from that calculation when it comes to COVID impacted years. From 2019 all the way through to 2022, clubs were able to relieve or add back COVID-19 costs as defined by the Premier League. And they stitched two periods together, 2019-20 and 2020-21. They were effectively amalgamated into one reporting period. So we're still looking, even in 22-23, back into a COVID period because we've amalgamated those two periods together. So that gets quite complicated, and again, this is something that we've covered in our course, the Professional Certificate in Football Finance. And if you want to learn more about that, feel free to email us at info@footballfinancepro.com, and we're happy to share more information on that particular topic. But from the Premier League's perspective, and we will look at this in a future video from Chelsea's point of view, because it looks like they're really pushing the boundaries, we still have to deal with these COVID-related costs. And the Premier League has defined COVID costs as lost revenues, particularly when it comes to match day and broadcasting revenues which were lost or had to be repaid to broadcasters, as well as any additional costs that were incurred by clubs during those 3 seasons. Now, for those with a good memory, the impact of COVID-19 in 21-22 was not that significant. When it comes to fans being allowed back into stadia, the full season was available. The previous season to that, 2021, was pretty much played behind closed doors. So the Premier League, as well as UEFA, were allowing lost revenues as a result of COVID-19 to be added back, with 2018-19 being the reporting period that would be used as a yardstick to adjust back to. But the Premier League took on another level of relief, which meant that costs that were incurred as a result of COVID-19 would be added back to the profitability and sustainability calculation. So make sure you subscribe if you want to know more about that from Chelsea's perspective, because we will look at that in a future video. So for those of you that are looking at Chelsea's financial results and seeing that the 21-22 season, they lost almost £115 million before tax. The previous season was almost £149 million before tax. The previous season before that was actually a profitable season. And the season before that, which is important because the 2 middle seasons will be treated as one, was £101 million of a pre-tax loss. So that's Chelsea Football Club, the legal entity. Why have we looked at that? From the Premier League's perspective, it's the club that matters. Now, UEFA's perspective is slightly different. It takes a group approach to football activities, and therefore a different set of financial results will be reported to UEFA. However, the Premier League will see those financial results. So if they're significantly different, the Premier League does have the right to say, well, I want to see a different set of reports that will be submitted to the Premier League for the purposes of profitability and sustainability. But as per the handbook, it's the club legal entity that matters. So any of you that were just listening closely to those 4 periods of profit before tax or loss before tax when it comes to the period 2019 all the way through to 2022, you'll have quickly calculated losses of £325 million over a 4-year period. So how could they possibly comply with the profitability and sustainability rules, which say that clubs can only lose £105 million maximum over a 3-year period? And again, that 3-year period being 4 seasons because of COVID. Well, this is where the reliefs come in. And again, we'll look into this in more detail in our next video, so make sure you subscribe if you want to know more about Chelsea in particular. But you have a cost adjustment for any costs related to the academy, infrastructure or depreciation costs on infrastructure, women's related costs that are within the legal entity or the group that you're reporting, and any community activities. So they're significant adjustments, estimated at somewhere between £30 or £35 million per season. So straight away, based on our calculations, you have £115 million of adjustments that will be taken off that £325 million figure. These are the standard adjustments that Chelsea will have made each season alongside every other club. And these reliefs are there to incentivise clubs to invest in certain aspects of the future of the club, whether that's physical infrastructure, the local community, the women's team, or the academy. These are items that have been thought about very well to make sure that the clubs aren't just spending on the here and now. So therefore, they don't count towards financial fair play. But when it comes to COVID-19 costs, which would be applicable or relievable from the Premier League's perspective over 3 of those 4 periods under review, if we're looking back from the end of 2022 all the way back to 2019, the costs that we estimate that would be relievable there total over £200 million, which means that over that period, based on our calculations, some of which are estimated because the information isn't disclosed within the financial statements, it does look as though Chelsea are compliant within the profitability and sustainability rules within that period from 2019 to 2022. What's more concerning is the results from 22-23, which are not yet available. So if you're interested in learning more about that particular topic and that period, which will be reported to UEFA but not assessed, but there's still a compliance issue when it comes to the Premier League profitability and sustainability rules, please tune in next time. Make sure you hit the subscribe button. And if you've liked the video, please hit like, leave a comment below, particularly if you're interested in learning more about Chelsea Football Club's FFP compliance or potentially not in the future. Share the video with your friends. My name's Neil Wood and I'm a football finance professional, and thanks for watching as always.